I'm George Soros. I've been investing for over 70 years, and I'm worth about $7 billion. The biggest financial disasters I've witnessed in my career weren't caused by people taking obvious risks. They were caused by people who thought they were being safe, people who followed conventional wisdom, people who believed in safe investments that turned out to be anything but safe. In 2008, I watched millions of Americans lose their homes because they believed real estate was the safest investment you could make. Houses always go up in value, they said. Real estate never crashes, they said. Those people lost everything, not because they were reckless, but because they believed a lie about safety. In the 1970s, I saw investors park their money in government bonds and savings accounts, thinking they were being conservative. Inflation destroyed 50% of their purchasing power in a decade. They thought they were protecting their wealth, but they were systematically impoverishing themselves. Right now, millions of people are making the same mistakes, believing the same lies about safety that have destroyed wealth for generations. They're putting their money in investments that feel safe, that everyone says are safe, but that are actually some of the most dangerous positions you can take in today's environment. The problem isn't that these people are stupid. The problem is that they've been conditioned to believe that certain investments are automatically safe without understanding what safety actually means or how market conditions can transform safe investments into wealth destroyers. Today, I want to expose the 5 biggest lies about safe investments, lies that are so deeply embedded in conventional wisdom that most people never question them. These lies are particularly dangerous because they prevent people from seeing the real risks they're taking and the real opportunities they're missing. What I'm going to tell you might make you uncomfortable because it challenges everything you've been taught about investing safely. But after 7 decades of watching markets destroy the wealth of people who thought they were being careful, I can tell you this: the biggest risk you face isn't losing money on a bad investment. It's losing money on an investment you thought was safe. Because here's the truth that the financial industry doesn't want you to understand. There is no such thing as a truly safe investment. There are only different types of risk, and the people who build real wealth are the ones who understand which risks are worth taking and which ones aren't. So let me show you the 5 lies that are destroying more wealth than any market crash ever could, and what you should be doing instead. Lie number 1, government bonds are always safe. This is perhaps the most dangerous lie in all of investing, and it's one that has cost investors trillions of dollars over the past few decades. The financial industry has convinced people that government bonds, especially US Treasury bonds, are the safest investment possible because they're backed by the full faith and credit of the government. But here's what they don't tell you: governments have defaulted on their bonds throughout history. And even when they don't technically default, they often destroy bondholders through inflation and currency debasement. I lived through the bond massacres of the 1970s and early 1980s when long-term government bonds lost 60 to 70% of their real purchasing power. People who bought 30-year Treasury bonds in 1965 thinking they were being conservative watched their investments get decimated by inflation over the next 15 years. The 30-year Treasury bond yielding 4% that looked so safe in 1965 was paying the same 4% in 1980, but everything else cost 3 times as much. Those safe investors lost 2/3 of their wealth while thinking they were being prudent. And this pattern repeats throughout history. In Germany during the 1920s, government bonds became worthless as hyperinflation destroyed the currency. In Argentina, Russia, and dozens of other countries, government bondholders have been wiped out when economic policies made it impossible for governments to honor their obligations in real terms. Today's situation is even more dangerous because global debt levels are higher than they've ever been in history. The US government has over $34 trillion in debt and is adding $1 trillion more every year. Interest payments alone now consume over 15% of federal revenues, and that percentage is growing rapidly as debt levels increase and interest rates rise. The mathematical reality is that this debt can never be repaid at current values. The only options are default, which is politically impossible, or inflating away the debt, which is what governments always choose. Either way, government bondholders get destroyed, but here's the reflexivity aspect that makes this even more dangerous. The more people believe government bonds are safe, the more willing they are to accept low yields, which makes it easier for governments to borrow more money and create even bigger problems down the road. Right now, people are buying 10-year Treasury bonds yielding 4.5% when inflation is running at 3 to 4% and likely to go higher as government spending continues to explode. They're accepting a real return of maybe 1% per year while taking enormous risk that inflation will accelerate or that currency debasement will destroy their purchasing power. The alternative isn't to avoid all government bonds, but to understand that they're not safe and to position accordingly. Short-term bonds reduce interest rate risk. Foreign government bonds from fiscally responsible countries provide currency diversification, and inflation-protected bonds provide some protection against monetary debasement, though even these have limitations when governments manipulate inflation statistics. The key insight is that safety doesn't come from owning assets that are labeled as safe. Safety comes from understanding the real risks you're taking and positioning your portfolio to handle different scenarios. Government bonds might be appropriate for part of your portfolio, but only if you understand that you're taking inflation risk, currency risk, and even default risk depending on the government and time frame involved. Lie number 2, cash is the safest investment. The second lie that destroys wealth is the belief that holding cash is the safest position you can take. This lie is particularly seductive because cash feels safe. It is there, it's liquid. You can't lose it in a market crash. But cash is actually one of the most dangerous long-term positions you can hold because it guarantees that you lose purchasing power over time. I learned this lesson personally during the inflationary 1970s, when I watched people who kept their money in savings accounts and certificates of deposit lose 50% of their purchasing power over a decade. They thought they were being safe by avoiding the stock market, but they were systematically impoverishing themselves through inflation. The problem with cash isn't just inflation, it's the opportunity cost. While you're earning 1 to 2% in a savings account, inflation is running at 3 to 4%, which means you're losing 2 to 3% of your purchasing power every year. Over 20 years, that compounds into a massive loss of wealth. Let me give you a concrete example. If you had $100,000 in cash in 2000 and just held it in savings accounts, earning the prevailing interest rates, you'd have about $150,000 today. That sounds like you made money, right? But everything costs twice as much now as it did in 2000, so your $150,000 today has the same purchasing power as $75,000 in 2000. You lost 25% of your wealth by being safe. Meanwhile, if you had invested that $100,000 in the stock market in 2000, despite living through the dot-com crash, the 2008 financial crisis, and the 2020 pandemic crash, you'd have about $400,000 today. That's the cost of safety. You gave up $250,000 in wealth because you were afraid of volatility. But the cash problem gets even worse in today's environment because central banks have made it clear that they're committed to creating inflation. The Federal Reserve has an explicit 2% inflation target, which means they're trying to reduce the purchasing power of your cash by 2% every year. That's official policy. And here's the reflexivity trap The more people hold cash because they think it's safe, the more central banks can get away with inflationary policies because the political cost is hidden. People don't immediately feel the impact of inflation the way they feel the impact of a stock market crash, so politicians can steal from savers gradually without facing immediate consequences. The current situation is particularly dangerous because real interest rates, the difference between what you earn on cash and the inflation rate, are deeply negative. You're getting maybe 4 to 5% on high yield savings accounts, while inflation is running at 3 to 4% officially, and probably higher in reality. So you're losing purchasing power even in nominal terms when you account for taxes on that interest income. Cash does have a role in a portfolio, but only for specific purposes: emergency funds, short-term liquidity needs, and tactical positioning during market transitions. But holding large amounts of cash as a long-term strategy is guaranteed wealth destruction. The alternative is understanding that some volatility is the price you pay for maintaining and growing your purchasing power over time. The stock market is volatile in the short term, but it's the only major asset class that has consistently outpaced inflation over long time periods. The key insight is that what feels risky in the short term, mining stocks, real estate, commodities, is actually safer in the long term than what feels safe. Cash feels safe because the number doesn't go down, but the value it represents is constantly being eroded by forces beyond your control. Lie number 3, diversification eliminates risk. The third lie is probably the most widely believed myth in modern finance, that diversification eliminates risk. The financial industry has convinced people that if you spread your investments across different asset classes, different sectors, different countries, you've somehow eliminated the possibility of significant losses. This is complete nonsense, and it's dangerous nonsense because it gives people false confidence. I learned this lesson during the 2008 financial crisis when I watched supposedly diversified portfolios collapse together. Stocks fell, bonds fell, real estate fell, commodities fell, international markets fell, everything fell at the same time because diversification only works when correlations remain stable, and correlations always break down during crisis periods. The problem with diversification theory is that it's based on historical correlations that assume the future will look like the past. But during crisis periods, when you most need diversification to work, correlations increase dramatically as investors panic and sell everything they can sell. In 2008, supposedly uncorrelated assets like US stocks, European stocks, Asian stocks, real estate investment trusts, and commodity funds all fell 30 to 50% at the same time. People who thought they were protected by diversification discovered that their balanced portfolios lost just as much as concentrated portfolios. The reflexivity principle explains why diversification fails when you need it most. Market crashes are driven by psychology and liquidity needs, not by fundamental analysis of individual assets. When people need cash, they sell whatever they can sell, regardless of whether those assets are fundamentally related to each other. But here's the even bigger problem with diversification. It doesn't just fail to eliminate risk, it often increases risk by diluting your returns from your best ideas while exposing you to mediocre investments you don't understand. Warren Buffett understood this when he said, "Diversification is protection against ignorance. It makes little sense if you know what you are doing." If you've done your homework and identified a few excellent investments, why would you dilute those with dozens of mediocre ones just to achieve diversification? The modern portfolio theory approach of owning hundreds of thousands of stocks through index funds guarantees that you'll earn mediocre returns because you're forced to own both the winners and the losers. You're diversifying away excellence in the name of safety. Now, I'm not saying diversification has no value, but it's important to understand what diversification can and cannot do. Diversification can reduce a specific company risk, the risk that any individual company fails or performs poorly, but it cannot eliminate market risk, inflation risk, currency risk, or political risk. True risk management requires understanding the different types of risk you face and addressing each one appropriately. You can't diversify away inflation risk by owning more stocks. You can't diversify away currency risk by owning more US assets. You can't diversify away political risk by owning more financial assets. Real risk management requires owning different types of assets that respond differently to different scenarios: physical gold for currency collapse scenarios, foreign assets for US political risk, real estate for inflation scenarios, cash for deflation scenarios. This is strategic diversification based on understanding different risks, not statistical diversification based on historical correlations. The key insight is that diversification is a tool, not a solution. It should be used strategically to address specific risks, not as a blanket approach to eliminate all risk. And it should never be used as a substitute for understanding what you own and why you own it. Lie number 4. Blue chip stocks are safe long-term investments. The fourth lie is the belief that blue chip stocks, large, established companies with long histories and strong reputations, are safe long-term investments that you can buy and hold forever. This lie has probably destroyed more wealth than any other single misconception, because it encourages people to ignore fundamental changes in business conditions and hold losing positions far too long. I've watched this lie play out repeatedly throughout my career. In the 1970s, people thought IBM was the safest stock in the world. It was the dominant computer company, had a virtual monopoly in mainframe computers, and paid reliable dividends. IBM was the ultimate blue chip stock, and conventional wisdom said you could buy it and never worry about it again. But technology changed. Personal computers made mainframes less relevant. IBM's monopoly disappeared. The stock went nowhere for 2 decades, while the overall market tripled. People who bought IBM thinking it was a safe blue chip investment missed decades of wealth creation in other sectors. The same pattern repeated with Kodak, which dominated photography for over 100 years, General Motors, which dominated automobiles for decades, Sears, which dominated retail, GE, which was considered the best managed company in America. All of these blue chip companies eventually became terrible investments as their industries changed and their competitive advantages disappeared. The problem with blue chip thinking is that it assumes business conditions remain static, which they never do. Companies that dominate today's economy may be irrelevant in tomorrow's economy if they fail to adapt to changing conditions. This is particularly dangerous in today's environment because the rate of technological and economic change is accelerating. Artificial intelligence, automation, and globalization are disrupting established business models faster than ever before. Companies that look dominant and stable today could be obsolete within a decade. But here's the reflexivity aspect that makes blue chip stocks even riskier. The more people believe certain stocks are safe blue chip investments, the more expensive they become relative to their actual prospects. When everyone thinks a stock is safe, the price gets bid up to levels that assume perfect execution and no competitive threats. Look at the current market darlings: Apple, Microsoft, Google, Amazon. These are all excellent companies, but they're priced as if they'll dominate their industries forever and grow at high rates indefinitely. History suggests this assumption is unlikely to prove correct. Apple trades at a $3 trillion valuation based on the assumption that people will continue to upgrade their phones every few years forever and that no competitor will challenge their ecosystem. Microsoft trades at a $3 trillion valuation based on the assumption that their cloud computing dominance will continue indefinitely. These assumptions may prove correct, but they are not safe assumptions. The real risk in blue chip stocks isn't that they'll disappear overnight. It's that they'll deliver mediocre returns for long periods as their growth slows and their competitive advantages erode. Investors who buy them thinking they're safe often hold them through decades of underperformance because they confuse business quality with investment safety. The alternative approach is understanding that business success and investment success are different things. A great company can be a terrible investment if you pay too much for it. And a mediocre company can be a great investment if you buy it cheaply enough. True safety in stock investing comes from understanding what you're paying for a business relative to what it's likely to earn over time, not from buying stocks that are perceived as safe. It comes from diversifying across different types of businesses that respond differently to different economic conditions. The key insight is that no individual stock is truly safe, regardless of how blue chip it appears. Business conditions change, competitive advantages erode, and management makes mistakes. The safest approach is owning a portfolio of carefully selected businesses at reasonable prices, not concentrating in a few blue chip names just because they feel safe. Lie number 5, real estate always goes up in value. The fifth and final lie is probably the most expensive one for average investors, the belief that real estate always goes up in value and therefore represents a safe conservative investment. This lie reached its peak during the mid-2000s housing bubble, when millions of people bought houses they couldn't afford because they believed real estate was the safest investment you could make. I watched this bubble inflate in real time and positioned against it through various investment strategies because it violated every principle of sound investing. People were buying houses with no money down, taking on mortgage payments they couldn't afford, and assuming that rising house prices would bail them out. They thought they were making conservative investments, but they were actually making highly leveraged speculative bets. When the bubble burst in 2007 to 2008, millions of homeowners discovered that real estate doesn't always go up. House prices fell 30 to 50% in many markets, wiping out trillions of dollars in supposed wealth. People who had bought houses thinking they were safe investments lost their homes, their credit, and their financial futures. But the problem with real estate goes deeper than just the housing bubble. Even in normal markets, real estate is not the safe investment that people believe it to be. Real estate is illiquid, expensive to maintain, subject to taxes and regulations, and highly dependent on local economic conditions that can change dramatically. Consider the long-term data from 1900 to 2000. House prices in the United States increased at an average rate of about 3% per year, just barely ahead of inflation. That means that real estate, on average, preserved purchasing power but didn't create significant wealth after accounting for maintenance costs, property taxes, and transaction costs. Meanwhile, stocks returned about 10% per year over the same period, creating enormous wealth for long-term investors. Real estate felt safer because it was less volatile and more tangible, but it was actually much less rewarding as an investment. The current real estate market demonstrates how dangerous the real estate always goes up mentality can be. House prices have more than doubled in many markets since 2012, driven by artificially low interest rates and speculative buying. People are once again buying houses they can barely afford because they believe prices will continue rising indefinitely. But interest rates have increased dramatically, making mortgages much more expensive. Construction costs have soared due to material and labor shortages. Property taxes are rising as local governments face budget pressures. And demographic trends suggest that housing demand may decline as baby boomers downsize and younger generations delay home buying due to affordability issues. The reflexivity principle applies strongly to real estate because housing markets are driven more by psychology and credit availability than by fundamental supply and demand factors. When people believe real estate always goes up, they're willing to pay higher prices and take on more debt, which drives prices higher and reinforces the belief. But this cycle can reverse quickly when conditions change. Real estate can be a reasonable part of a diversified portfolio, but only if you understand its limitations and risks. A rental property can provide income and inflation protection if you buy it at reasonable prices in areas with strong rental demand. Real estate investment trusts can provide diversified real estate exposure with better liquidity than direct ownership. But buying a house as your primary investment strategy, especially with high leverage, is not conservative or safe. It's a concentrated bet on one asset in one location using borrowed money. That's actually one of the riskiest investment strategies you can pursue. The key insight is that real estate, like any other asset, can be appropriately priced, overpriced, or underpriced depending on market conditions. There's nothing inherently safe about real estate just because it's tangible and familiar. Safety comes from understanding value, not from owning particular types of assets. Understanding real risk and real safety. Now that I've exposed these 5 lies, let me explain what real safety actually means in investing, because it's not what most people think it is. Real safety doesn't come from owning assets that are labeled as safe. It comes from understanding the different types of risk you face and constructing a portfolio that can handle multiple scenarios. The biggest risk most people face isn't market volatility, it's inflation and the gradual erosion of purchasing power over time. A portfolio that protects you from short-term market fluctuations but loses purchasing power every year is not safe. It's guaranteed wealth destruction disguised as safety. The second biggest risk is concentration risk, mix, having too much of your wealth dependent on any single asset, currency, or economic system. This is why holding all your money in cash is dangerous. It's why owning only US stocks is dangerous. It's why having all your assets denominated in dollars is dangerous. True safety requires diversification across different types of risks, not just different assets within the same risk category. You need assets that perform well during inflation, assets that perform well during deflation, assets that perform well during deflation, assets that perform well during economy growth. This might include stocks for long-term growth and inflation protection, foreign assets for currency diversification, physical gold for monetary crisis protection, real estate for tangible asset exposure, and some cash for liquidity needs. But each component should be chosen based on its role in the overall risk management strategy, not because it's perceived as safe in isolation. The reflexivity principle tells us that what's perceived as safe often becomes dangerous precisely because of that perception, while what's perceived as risky often becomes safer because fewer people are willing to take those risks. This creates opportunities for investors who can think independently and avoid following the crowd. The psychology of false safety. Understanding why people fall for these lies about safety is crucial for avoiding them yourself. The desire for safety in investing comes from a natural human aversion to uncertainty and loss, but this psychological tendency often leads to behaviors that create the very outcomes people are trying to avoid. People prefer the feeling of safety over actual safety because actual safety requires accepting some uncertainty and volatility. It's psychologically more comfortable to hold cash and watch it lose purchasing power gradually than to hold stocks and watch them fluctuate in value, even though the stocks are likely to preserve and grow purchasing power over time. The financial industry exploits this psychological preference by marketing products and strategies that feel safe rather than products that are actually safe. government bonds, bank deposits, and balanced mutual funds all feel safe because they're familiar, widely accepted, and don't appear to be risky on the surface. But feeling safe and being safe are completely different things. The people who felt safest in 2007 were the ones who owned houses they thought would always appreciate and mortgage-backed securities that were rated AAA. Those same people lost the most when their safe investments turned out to be extremely dangerous. The key insight is that true safety in investing requires intellectual courage, the willingness to think independently, to question conventional wisdom, and to accept some uncertainty in order to achieve better long-term outcomes. This isn't easy, but it's necessary for building and preserving wealth over time. Practical implementation strategy. So, how do you actually implement a truly safe investment strategy given everything I've discussed? It starts with changing your definition of safety from avoiding all risk to managing different types of risk appropriately. First, accept that there is no risk-free option. Every investment choice involves trade-offs between different types of risk. The goal is choosing the risks you understand and can manage rather than trying to avoid all risks, which is impossible. Second, focus on preserving and growing purchasing power rather than preserving nominal value. A portfolio that maintains its nominal value but loses purchasing power is not safe. It's a slow-motion disaster. Third, diversify across different types of assets and risks, not just different assets within the same risk category. Own assets that respond differently to different economic scenarios rather than owning many similar assets. Fourth, maintain some liquidity for opportunities and emergencies, but don't hold excessive cash for long periods. Cash is a tool for timing and flexibility, not a long-term wealth preservation strategy. Fifth, stay informed about economic conditions and be willing to adjust your strategy as conditions change. What's appropriate during periods of low inflation and economic stability may be inappropriate during periods of high inflation and economic uncertainty. The specific allocation depends on your situation, time horizon, and risk tolerance, but the principles remain consistent. Understand what you own and why you own it. Diversify across different types of risks and focus on long-term purchasing power, preservation, and growth rather than short-term comfort and stability. Final thoughts on investment safety. After 7 decades of investing through every type of market condition imaginable, I can tell you that the biggest mistakes I've seen weren't made by people who took obvious risks and lost. They were made by people who thought they were being safe, but were actually taking enormous risks they didn't understand. The widow who kept all her money in savings accounts and lost half her purchasing power to inflation wasn't being safe. She was being reckless. The retiree who bought 30-year treasury bonds in the 1960s and watched inflation destroy their value wasn't being conservative. He was making a highly speculative bet on monetary policy. Real safety comes from understanding the economic environment you're operating in and positioning accordingly. In an environment of high government debt, expansionary monetary policy, and geopolitical instability, the safest strategy is probably owning a diversified portfolio of real assets minus stocks, real estate, commodities, foreign currencies, rather than financial assets backed by governments and institutions that may not be able to honor their commitments. This doesn't mean being reckless or speculative. It means being realistic about the risks you face and the tools available to manage those risks. It means accepting some volatility in order to avoid the guaranteed erosion of purchasing power that comes from following conventional safety advice. The 5 lies I've exposed today, that government bonds are always safe, that cash is the safest investment, that diversification eliminates risk, that blue chip stocks are safe long-term investments, and that real estate always goes up. All variations on the same fundamental error, confusing familiarity and conventional wisdom with safety. True safety requires independent thinking, careful analysis, and the courage to position differently from the crowd when conditions warrant it. This isn't easy, but it's the only approach that has consistently worked throughout history for preserving and growing wealth over long periods. The choice is yours. You can follow conventional wisdom and accept the gradual erosion of your wealth through inflation and poor investment choices, or you can think independently and position for the economic realities we actually face rather than the safe world we might prefer to live in.